Okay, class. So you are welcome again to Equity Professionals. Today, we are going to continue from where we stopped last week. Remember that we started looking at IFRS 2 share-based payments last week. And I explained to you that this standard came to be when entities started using their equity instruments to pay for goods or services. And this is even more common where they were using this form of consideration to pay for their employees, especially those at the executive level or for the directors. So they were paying them through their equity instruments. Now, we then looked at the different types of equity instruments, the different types of share-based payments that we could have. We looked at equity settled share-based payment transactions. We looked at the cash settled share-based payment transactions. And we looked at the one where either the supplier or the entity has a choice on whether it should be equity settled or cash settled. I told you that for the equity settled, this is one in which the entity receives good and in return, they pay with their shares or share option. While the cash settled is the one in which the entity receives goods and in exchange for that, they promise to pay cash. But the amount of cash they would pay is based on the share price of the company. The third one is where there is a choice of settlement. So last week we looked at basically about equity settled share-based payment. We focused on that last week. Now today we are going to sort out the outstandings. Then we looked at some terminologies before I went into the core accounting. And when it comes to the core accounting, which is regarding how you recognize share-based payment transactions in the account. Regarding how you recognize share-based payment transactions in the account, we said that you can only recognize share-based payment transaction when the entity has received the goods or service. As soon as the entity receives the goods or services, then you can recognize it in the books. However, when you have equity settled transactions, equity settled share-based payment, where the entity receives good and return, they pay with their equity. The way you enter that in your books, the way that is recognized, is just for you to debit expense or assets, depending on the type of goods or services the entity has received, right? And you credit equity reserve. But if it is a cash settled share-based payment, we said you would also debit goods, you also debit either asset or expense, depending on what goods or services the entity has received, and you will credit liability. And I told you the reason why we are crediting liability is that there is a promise to pay cash, though the amount of cash is dependent on the share price of the company. But whenever you have an obligation to deliver cash, that has to be liability. That's why the other leg for cash settled share-based payment is liability. So that's the recognition. That's how you enter it in the books. So the one we did not look at last week regarding recognition is the one where there is a choice of settlement. We are going to carefully look at it today. Then we moved on to measurement. For measurement, we need to understand how you measure equity settled share-based payments, how you measure cash settled share-based payments, and the one where there is a choice of settlement between either equity settled or cash settled. We looked at equity settled last week. And we said that, how do you get the value that you would use to measure or you attach to what you have recognized in the books? We said that for equity settled, what you have recognized in the books is either you have recognized is either you have recognized expense or assets, or you have recognized equity. So, and each expense or asset or equity, both side has distinct value, because the buyer or the seller of that goods or services must have issued an invoice to the entity at an amount. But instead of the entity to pay that amount, he has promised to pay with his own equity instrument. That also has a value. So which value are we going to use? I told you that the costs, the cost you would use is the cost of the goods or services received. So generally, the general principle in IFRS 2 is that when an entity receives goods or services and it pays with its equity, we are going to measure that transaction at the fair value of the goods or services received. That was what we agreed last week. However, you can only measure at the fair value of the goods or services received when you even have that value. Okay, especially if the transaction is with suppliers, people other than your employees, suppliers. However, where the transaction is with your employee, then it's not possible for you to measure the goods or services rendered by the employee, especially the portion that you are paying with equity, is impracticable. For that reason, then you will have to measure that transaction by reference to the fair value of the equity instrument granted. And this was where our discussion then became lengthy, because we now focused on where the transaction is with an employee. Where the transaction is with an employee, then you can only measure that transaction at the fair value of the equity instruments granted. Then we went ahead to explain that when it comes to an employee, what the services they render to the entity is not a service that is rendered at a point in time. It's a service that is rendered over time. For that reason, the transaction itself must also be recognized over time. If it is at a point in time, if it's a transaction like with an outside supplier, somebody came to offer us service. It's a one-off transaction. The person just offers service and we pay. That one is straightforward. But when it comes to employee, the service is always as long as the employee is with us. So if you have now promised the employee that you will issue him shares, of course, there will be vesting conditions. If he stays with you for 3 years or for 4 years, how do you then recognize that? I explained to you last week that you would not wait until the expiration of that period, which is the vesting date, before you recognize that share-based payment. You are going to recognize it over the period the service is received. And don't forget, you recognize share-based payment transaction when an entity receives goods or services. So since when transaction is with employee, the goods or services are received over time, then at the end of each year, then you need to be recognizing a portion of what you have promised the employee. You need to recognize a portion of it. And that was what we really focused on last week. And the point of my explanation, the way I explained to you last week, is that at the end of each year, the entity needs to determine the estimate of the number of employees that will vest or that will become entitled to that equity instrument or that shares. Because it's not all the employee that will actually vest or that will be there when the equity instruments will become granted or will vest. So at the end of each year, you need to then know, okay, how many employees will be there when these things become matured or when we are supposed to issue these shares to the employee. The question will give you a guide on these estimates. Though in real life, nobody is going to give you a guide. You are the one that will estimate. So on the basis that they could give you these estimates in a lot of ways. The ones we looked at last week were the ones where some employees left in each year. And on the basis of the employee that left at the end of that year, they estimated the number of employees that will leave over the period. Then we were then using that to determine at the end of each year, how many employees will actually vest. Not will actually vest, but an estimate of them that will vest. And it's on that basis we were able to know our exposure at the end of that year, which we will then spread over the period. If you had revised these notes, all of these I'm saying will make sense to you. So we solved some questions that last week. We solved this question up to this point. So majorly, that was what we looked at last week. Now, you see, still looking at it from the perspective of employees, because that's what you will find in your exam. And that's what is even common in practice. So that's what you would see. However, when you grant shares to your employee or when you promise them shares in the future, that for the portion of this service you have rendered to us, or if you continue to stay with us, or if you can achieve certain targets, we will give you some shares. You see, what makes that kind of deal attractive to your employee is the fact that the price at which you are promising that they will get those shares, those price must be very low. Don't forget, at the vesting date, the employees will be required to pay a token. And this token we call the exercise price. And what makes this deal attractive to the employee is that at the end of each year, I mean, when they are looking at the exercise price, they should be seeing that it is far lower than the share price of the company. So if, for example, you told your employees that you are going to give them some shares after 3 years, and those shares, they can buy it for 2 naira. What will make them excited is the fact that at the end of each year, if your share price is like, for example, 10 naira, they'll be excited and they'll be looking forward to getting those shares because they know that if your price remains at 10 naira, at maturity, if they can buy it for 2 naira, a lot of them that don't want to hold it or that needs money quickly can go and sell it in the open market for 10 naira and they will get so much money. You see, that's what makes it attractive to them. But business dynamics and economic environment will change. And we should be ready for that as an accountant. Then what happens if the share price of the company starts falling? And this deal is now looking very unattractive to the employees. What should the company do? And that is what we want to discuss under modification. You see, going straight to the point, what the company should do is quite simple. what they should do is to reprice the exercise price. And how do they do that? So if you had promised your employees that at maturity, they are going to get some shares after some years, at the vesting day, they will get it at 2 naira. And I told you that what makes this deal attractive is the fact that the share price of the company is actually high. Is high. So the employee will be happy. Share price that is this high. They want us to buy it for this low amount. So if the share price now is coming closer to the exercise price or lower than it, people will be concerned that this thing has no value anymore. Then modification then comes in. So what we expect the company to do is that the entity should reprice by reducing the exercise price. By reducing the exercise price. So if the company share price, let's say the exercise price promised initially is 2 naira, and they saw that the share price of the company is falling. The only way they can make it attractive is to also continue to further reduce how much the employee will be required to buy it at vesting date, which is the exercise price. So when they do that, that's what we call repricing here. It's no more than that. When the company does that, you see, it maintains the attractiveness of that equity settled share-based payment. The employees' excitement then is now sustained. It should be continued, right? And you see, the value of this deal is how you measure it. And don't forget, you measure equity settled share-based payment at the fair value of the share option at the grant date. Don't forget, that was how we measure it. So as soon as the entity reduces its exercise price, the fair value of the share option will also increase by the same proportion. Even though the examiner will not ask you to calculate this, they will tell you. But when they tell you and you see it, you should not be surprised, because you should know that naturally that is what will happen. Because when the exercise price reduces, as a result of what the employer has done, reducing the exercise price, the fair value of the share option at the grant date would also increase by the same proportion. Okay, which goes to show that okay, yes, this equity settled transaction is now more valuable, that it's now valuable. So how do we account for all of this situation? So the only thing from this my entire scenario, the only impact that we're going to have here is just the fact that this thing is changing. The fair value of the share option at the grant date is changing, because that's the only item that we use from all I've taught you so far. The exercise price, we don't need it until when we want to buy or sell the shares to the employees. What we use is the fair value of the share option at the grant date. That's what we usually use. So if that one is going up, that means our valuation at the end of each year will also change. So to make it simple, so the standard requires that you continue to recognize the original package, as you have been doing it, using the fair value of the share option at the grant dates, the old one. Then the increase in the fair value of that share option, then you also account for that separately as well. You will see that with the correction. So just to make it continually simple, you will continue to do what you are doing. So the increase in that fair value of share option, you would also account for that separately, right? Just for simplicity. So let's look at this question to practicalize what I've said so far. So this question goes as thus. It said, Delta prepares financial statements to 31st December each year. It now said on 1st January 2002, Delta granted 500 share options, each to 10 senior executives. The option vests on 31st December 2005, provided the relevant executives remain in employment and provide services to Delta until that date. Okay, so this one is saying they issued share option to 500 share options to 10 employees. It will vest in 31st December 2005. That's after 2, 3, 4, 5. That's 4 years. Okay. Now said on 4th January 2002, Delta estimated that 10 executives will remain in employment for the 4-year period and so will be entitled to exercise the option. So they are estimating at the beginning of the year. This is not useful to us because I've told you that the estimates of the number of employees that we vest is usually made at the end of each year. So I'm not going to use this paragraph for anything. However, they said the estimate was confirmed on 31st December 2002. Good. So they confirmed the estimate that, okay, 10 employees will vest after 4 years. And also 31st December 2003. So they confirmed it. They now said that the fair value of the option on 4th January 2002 was 2.2, which represents the fair value at the grant date. 2.2, which is what we use to measure the share option at the end of each year. We're now told that during the early months of 2003, the share price of Delta fell significantly, and on 30th June 2003, Delta repriced the option package by reducing the exercise price from 4 naira per option to 3 naira per option. So look at it. They said during the early months of 2003, okay, after 1 year, the share price of Delta fell significantly. So the share price fell. And on June, he repriced the option package by reducing the exercise price from 4 naira to 3.4 naira. That's the rational thing to do. This caused the fair value of the option at 30th June 2003 to increase by 60 kobo. Like I've told you, as I was saying, so at the end of year 1, which is at the end of 2002, they have already estimated that all employees, all the 10 executives will remain in employment for the 4 years. So the value of the option at the end of the first year is actually the 500 option multiplied by 10 senior executives multiplied by the fair value of the option at the grant date, which is 11,000. That's the value at the end of year 1. And this 11,000 is not like we would recognize and measure everything in year 1. Is what the value of the option is at maturity. But like I told you, we need to recognize it over the period, since we are going to be enjoying the service from the employee over the period. So you divide this by 4 because the vesting period is 4 years. So that means in each year, you recognize 2,750 for the 4 years. So you just debit staff cost, credit equity. That's the original. That's what, so nothing is going to change for that. However, remember, there was a repricing on 30th June 2003, which resulted in the increase in the fair value of the option by 60 kobo. So this one also, we are going to deal with it separately. So in addition to recognizing 2,750 each year, in addition to that, from the year of repricing, okay, at the end of that year, which is 31st December 2003, when the repricing occur. So you see that increase in fair value also, you are going to recognize that too, which is 500 multiplied by this 500 option, multiplied by 10 employees, since none of them is going to leave, multiplied by 0.6. So that means in addition to this 11,000 that would vest at maturity, there's now an additional 3,000 for them as a result of the increase by 0.6. So this 3,000 now, don't forget, it started from 30th June. Okay, it started from 30th June up until the maturity, which is December 2005. So if you count that from 30th June to December 2003, that is 6 years. Okay, by the time you count, I said 6 years, that's 6 months. By the time you count the 12 months in 2004 and the additional 12 months in 2005, that's 24 plus the 6, that's 30 months. So that means this 3,000 will be spread over 30 months. Okay. So at the end of 2003, the additional costs that we're going to recognize out of this 3,000, don't forget, this 3,000 is how much will vest at the vesting date. It's not like we are giving it to the employee now, it's just an additional cost that we vest at the vesting date. But we need to recognize it over that period, over that 13 months period. So at the end of December, we can only, that will be just 6 months through that period, since this 3,000 started from 30th June. Okay, so what we would recognize out of this 3,000, we just recognize 3,000 multiplied by 6 over 30. Okay, which gives us 600. So that means what you are recognizing in 2003 alone is, in addition to this 3,2,750 from the original package, you are also going to recognize additional 600 from the increase in the fair value of the share option. And that's what you recognize in 2003. And that solves the question. Just to be sure that you are following, because you guys are quite quiet tonight. So let me ask you, how much will be recognized in 2004? What's the total staff cost that will be recognized in 2004?
The additional cost based on the revaluation of the fair value will be 1,200 first. Then for the original option package, let me just try and calculate that one.
Don't change, it's still 2,750 now. Since it's 2,750 every year.
Yeah. Yeah, right. I was going to look at whether there's any estimate on somebody leaving. Yes, it's 2,750 plus 1,200. That makes it 3,950.
Fantastic, that's correct. Okay, so good. Okay, so that's how modification works. So modification is, there's nothing different from what we have learned before. The only thing is that there will be an increase in the fair value of the share option. So just for simplicity, treat it separately. So just consider that increase. So from the date of that increase up to the vesting date, then you can spread that increase over that period as well. That's modification. ICANN has never asked this before, but I mean, it's something you should focus on and be ready for them to ask. The second one, aside modification, is cancellation. You see, it's not uncommon that organization can change their strategic approach for employee compensation or remuneration. They can decide that they don't want to continue, or they want to discontinue with this share-based payment approach, that they want to give people their money, that they just want to compensate people outrightly instead of forcing the shares of the company on them. Or maybe the owners just feel they need more shares, their shares back. They don't want to sell so much shares to people. and they decide to buy it back or cancel. I mean, the idea is that they want to cancel this share-based payment. And for it to be cancellation, that means it has already started. So they just decided that, okay, we are not doing again in the middle. So how would that affect our accounting? Very straightforward. Very straightforward. So the cancellation will just be treated as an acceleration of vesting. Okay. So that means that any unrecognized vesting cost should be recognized immediately. So because you are the one that said you want to cancel. Even that means even if the employee have not even met the condition, they will get they will get like a cash equivalent of that value that's supposed to vest at the vesting date. Not when they are canceling, at the vesting date, they will get everything. Of course, people that are around. So that means that that selection of vesting means that they will compensate them. They will pay the employee. And the way that works is just to credit bank and debit equity. Credit bank and debit equity. So the only excess you can have or extraordinary situation we can have is a scenario whereby the compensation is now higher than the value of those shares they want to give. It cannot be lower because the employee will not accept. It can only be higher, all right? So if it's higher, simple, you just treat it as an additional employee cost, employment cost. If the compensation is higher, it's an additional cost to the company. And that's cancellation. Let's look at a practical scenario. So we have Epsilon, which prepares financial statements to 30th June each year. 30th June each year. It now said on 1st July 2002, Epsilon granted 200 options each to 50 employees. It granted 200 options to 50 employees. The options vest on June 2005, provided the employees remain in employment with Epsilon until that date. Sorry, give me a few seconds. Okay, as I was saying, the fair value of the option on 4th July 2002 was 2 naira 50 kobo. 2 naira 50 kobo. Now said, at 30th June 2003, it was estimated that 48 employees would remain in employment until 30th June 2005. Second paragraph. They said on 1st January 2004, Epsilon cancelled the option package. At that date, all 50 employees who were granted the options were still in employment. Epsilon made a compensation payment to the affected employees of 2 naira 70 kobo per option, which was the fair value of the option package on 4 January 2004 required. How would this transaction be accounted for? Okay. So first, we'll do it step by step. It all started 1st July. So that means the end of the first year is June 2003. So at the end of the first year, they made an estimate. So they estimated that 48 employees will remain, okay, until 2005. So that means the exposure of the company as at this date first is they are giving 200 options to 50 employees. So we'll get the fair value of the option at the grant date, which is 2.2 naira 50 kobo. So which is this? That gives us 8,000. So 48 times 200 times 2 naira 50 kobo. So whatever you get, you will then multiply by 1/3 because we are only recognizing a portion of it for year one. And that's what gave us 8,000. So 8,000 we recognize in year one by debiting staff costs and crediting equity. Now let's go to year two. But before the end of year two, which is June 2004, right? Something happened. There was a cancellation. Okay. And this cancellation happened at the beginning of the year. Sorry, yeah, at the beginning of the new year. And what cancellation does is that it's going to accelerate vesting. It will fast track the vesting. And don't forget, at this vesting date, okay, at that date, all 50 employees were still in employment. So that means the value of this option at that date is 50 employees times 200 times 250 kobo. Okay, whatever that value is, we remove the ones that we have recognized to P&L, which is the one in year one that had already been recognized. That means 17,000 is unrecognized. And this 17,000 remaining will vest immediately. That means this 17,000, we are going to debit employee costs and credit equity. Okay, so that means a total of 27,000, sorry, 17 plus 8. That's 25,000 will vest immediately. Okay, D wants to ask a question. Please go ahead.
Good evening. Sorry,
Hi.
please, how did you get 1/3? I thought
Okay,
it's supposed to be for 6 months.
which one?
So we have 48 times 200 times 250 kobo times 1/3.
Yes, so it's 3 years period now, from July 2002 till 30th June 2005. That's 3 years. So
Okay.
we are only recognizing the portion relating to year one in the first year alone. That's why we divided it by 3. I guess you're not in class last week, Abi?
No, I wasn't.
Oh, okay. Okay.
But
So,
now, sorry to interrupt, but
okay.
this one is not starting from January. It is okay, 30th June. All right. Thank
Yes,
you.
yes. All
Thank
right.
you.
Okay. So now, you see, immediately they did that cancellation, everything will vest, everything. So the value of the option at the end of year two is the entire 50 employees, because they told us all of them are still in employment, multiplied by 200, multiplied by the fair value of the share option and the grant dates. That's, if you calculate that, that's 25,000 minus what we had recognized before. So you see, an additional 17,000 will be recognized to employee costs, and the other leg credit to equity. So that means what is in equity now, as at the end of 2004, which is June,
It's cumulative.
is 25,000. And the whole of that 25,000, they are due to it immediately. That's what we mean by acceleration of vesting. Pay it to them immediately, because it is you that said you want to cancel. So that means that means we are not waiting to vesting date anymore. Okay, so that's clear. Acceleration of vesting. You recognize any remaining amount to staff costs and credit remaining to equity immediately, which is this 17,000. So the cumulative is 25,000. However, how did the company compensate them? In cash. So the compensation payment was 2 naira 70 kobo per option. If you do the math, this compensation payment here adds up to 27,000, which is 50 employees multiplied by 200 options multiplied by 2 naira 70 kobo. If you do your calculation, it gives you 27,000. That's the compensation payment. So good for the employee. That is even higher than the fair value of the option. So this compensation payment, they debit equity and they credit cash. because they will pay them money. Note that the balance in equity was 25,000. Now they have debited it with how much? 27,000. What happened to the remaining 2,000? Transfer it. Transfer it. Credit equity. Just to close equity account. Because equity cannot be negative. Credit equity and debit staff cost. Transfer it to staff cost. So it becomes an additional cost to the company in the amount of 2,000 naira. In the amount of 2,000 naira. And that is it. It's no more than that. Again, ICANN has never asked this before. Okay? And this cancellation and modification that I've explained briefly actually relates to equity settled, which is why I'm explaining it under equity settled. ICANN has not asked it before. So it's an area you need to just understand. It's straightforward. The principle is teaching is relying on what you have learned before, just some additional things. Like for modification, it's just the increment will be the additional thing there. And for cancellation, this one is even more straightforward. It's just, it will accelerate the entire and the entire vesting. Just get the value as at the end of that when it cancel. Well, just remove it from what you have recognized to date or till the beginning of the previous year. Whatever you have not recognized, recognize it so that you will know where we are today. Then look for how much they eventually paid the employee. Use it to close your equity. If your equity, if what they paid is now higher than what they are due to in terms of the fair value of the option, transfer that to staff cost, P&L. It becomes an additional cost to the company. And that's it. That's modification and cancellation. So on this note, we are done with equity settled. We are still coming back to equity settled when I get to deferred tax related to equity settled transaction. Please go ahead with your question.
No, it's not even a question. This cancellation, just looking at the scenario where can it ever happen that the employer will not cancel the entire option package, but will cancel it parts, in which case this question will now become more complicated. What we are looking at here is where the entire option package was canceled. When it's now canceled part, what you're advising is that we should just use the same principle and deal with it. For instance, they say out of these 250 employees with 200 options, they'll say, okay, 20 employees option. The options due to 20 employees has been cancelled, maybe because the employees elected to take up that cancellation. Then 30, we get to the terminal date of the vesting period. So I'm just thinking far how they can twist this question. So that it's not that this one is relatively straightforward, it seems anyway. So if they twist it like that, you are saying that the principle can still guide us, right? That is my question.
Very good question. And I'm happy that you said this one is straightforward. If this one is straightforward to you, congratulations. It will not be more than this in the exam. They cannot cancel part. Is either they cancel all or they cancel none. They cannot cancel parts. It cannot work now because what we had recognized in previous years, we didn't recognize in piecemeal. It's not something you can break down. We recognize a singular figure as a whole. So, and they cannot say they want to cancel out of the 200 option, they want to cancel 100 option. Then how do you then want to measure? That's huge because that's beyond this one. That becomes change in accounting estimate. Because that means you will have to restate the previous balances you have recorded before. So it's not going to happen.
Yes.
It's either they cancel all or they cancel none. Yeah. But if you say this one is simple, I'm happy.
No, I didn't say simple. Oh, no. I didn't say simple. I said it seems the way you have taught it, the way you have presented it, somebody can align with it. Not simple, please.
Yeah, there's nothing wrong if you say it's simple now. It's actually simple. Okay, so I mean, it won't be more than this. It won't be more than this. So I'm done with equity settled. And if you understand it till now, fine. If you had missed our last class, guys, you need to make up. Don't accumulate these things. As we are moving gradually, the funny thing is that today is our 5th class. We have 13 classes to go. So it's
Sorry,
not
sir.
long. Sorry?
Please, can you resend the material to the group page?
Okay, can another student resend it? You know that I'm teaching right now. So I don't want to leave this page. Another student can re-forward it. Did you just join the group?
Yes, sir.
Okay, can another person please forward it so that he can have access to it? Because I don't have my WhatsApp open and I don't have my phone with me right now. Please forward it for your diary. Okay, so let's move to cash settled. Cash settled is the same thing as equity settled. So I won't repeat any other thing. It's the same thing. How to calculate the value you recognize each year is the same thing. It's the same ideology. So the idea for cash settled, like I've told you earlier on, is the fact that the company will give cash, but the cash is based on the share price of the company. Is based on the share price of the company. So they call that share appreciation right, where the company says that, okay, I will give you a certain number of shares based on the increase in my share price. That's a form of cash settle. Or it could be that the entity grants the employees rights to future cash payments by granting them rights to shares that are redeemable. So they can give them shares now and tell them that, okay, after 2 years, we'll buy it back from you and we'll ultimately give you cash when the share price has increased. But the core substance here is that the company, the entity who is now the buyer or the receiver of service will ultimately pay cash. For that reason, I told you that the corresponding credit is liability because they have to pay cash. So because it is a liability, this is the only area of difference. So please note, the entity would remeasure the fair value of the liability at each reporting date. And since they are remeasuring the fair value of the liability, that means for cash settled, we are not going to use the fair value of the option at the grant date like we did in equity settled. For cash settled, we are going to be using the fair value of the option at the end of each reporting date. At the end of each reporting date. So you now find yourself in a situation whereby there will be changes in fair value. Of course, fair value will always change. And these changes will be recognized to P&L. I will show you very soon. That is the only difference between equity settled and cash settled. While equity settled is measured at the fair value of the option at the grant date, which is the day they issue that option, cash settled is measured at the end of each reporting period, at each reporting date, at the end of the year. That is the only difference. That is the only difference here. Now, that being the case, the other principle where you would have to recognize a portion in each year still applies. So only a portion recognized each year. So we will still be doing that proration, 1/3, 2/3, 3/3, like that, like we always do. And that is it for cash settled share-based payment. So let's look at this question. It says on 4th January 2001, An entity grants 100 cash share appreciation rights to each of its 500 employees on condition that the employees continue to work for the entity until 30th December 2003. That's how many years? 1, 2, 3. That's 3 years. During 2001, 35 employees leave. The entity estimates that a further 60 will leave in 2002 and 2003. During 2002, 40 employees leave, and the entity estimates that a further 25 will leave during 2003. During 2003, 20 employees leave. At December 2003, 150 employees exercise their SAR, share appreciation rights. Another 140 employees exercise their SAR at the 1st December 2004. And the remaining 113 employees exercise their SAR at the end of 2005. The fair value of the SARs for each year in which the liability exists are shown below, together with the intrinsic value at date of exercise. So they give us fair value at the end of each year, give us intrinsic value from 20 years required. Calculate the amount to be recognized in P&L for each of the 5 years ended at 4th December 2005, and the liability to be recognized in statement of financial position at 31st December for each of the 5 years. Okay, so let's pick it one by one and see if we can follow the same principle. At the end of 2001, okay, we need to calculate first how much is the value of this option. So we have 100 share options. We have 500 employees. However, some of the employees have left. So 35 has left at the end of the year 1. And they estimate that a further 60 will leave in year 2 and year 3. That means the estimate of total departure is how much? Is 95. Abi? 35 left year 1, and estimate of further 60 will leave in year 2 and year 3. So estimate of total departure is 35 plus 60, which is 95. So in year 1 is 100 SAR multiplied by 500 minus 95 multiplied by 14 naira for cover, which is the fair value at the end of the first year. Whatever you get is the value of that option. We cannot recognize the entire value in year 1. We will need to spread it over the vesting period, which is 3 years. That's why you multiply it by 1/3. That gives us 194,400. With this value, we debit staff costs, we credit liability. Similar to what we have done in equity settled. Nothing has changed here. In year 2, we're told that 40
For equity
employees.
settled, we used to credit equity reserve.
Yes,
While you were crediting liability, yes.
Exactly. Thank you very much. Yes. So here we credit liability. In year 2, 40 employees leave, and the entity estimates that a further 25 will leave in year 3. So who can tell me at the end of year 2 now, what's the estimate of total departure?
35 left, 40 will leave year 2. Then I say to be minus 35 plus 40 plus 25.
Fantastic.
Yeah.
Fantastic. I hope everyone is following the way you are following. I just hope so. Fantastic. Fantastic. So 35 plus 40 plus 25. That's the estimate of total departure. Of course, 35 has left in year 1, 40 has left in year 2, and an estimate of 25 will leave in year 3. So as at year 2 now, the estimate of total departure is 100. So in year 2, 100 SAR, what we are giving, 500 minus 35 that left in year 1, 40 that left in year 2, and 25 that will leave in year 3. So that's the total number of employees that will remain, whatever we get as balance. Multiply that by 100, multiply by the fair value of that option at the end of the year 2, which is this 15.50. So whatever you get here is the value of that option at the end of year 2. We cannot recognize the entire value in year 2 alone. Since it's a remeasurement, we will need to spread it over the 3 years. So since this is year 2, we just cumulate year 1 and year 2 together. That's why we are multiplying it by 2 over 3. We got 413,333. Of course, that will be what will be in our liability. That means our liability has increased from 194 to 413. Is the increment that we recognize as staff costs. Is increment that go to P&L. So the value at the end of year 2 is 413,333. We had recognized 194,400 in year 1. So the increment is what we recognize to P&L in year 2 as staff costs. Of course, that means the total that has gone to staff costs is still 413,333, but what goes to P&L is for that year alone, while liability will be cumulative. So that's year 2. That's settled. Now, in year 3, we're now told that 22 employees leave. But that is not the only people that left here, because in that year 3, that's the vesting date. That's when people will start collecting their cash. So we're told that 150 employees has exercised their XAR. And when we say exercise their XAR, it means that we are going to pay them. Cash settled, you are paying. It's not that those employees are not paying in cash settled. We are the one that will pay. So how much are we paying? That's the intrinsic value here. Okay, that's what we call the intrinsic, that's what the examiner will call the intrinsic value. How much we pay to the employee in the intrinsic value. So we are paying 15 naira to 150 employees. So at 2003, some employees had exercised. So 150 employees, each of them are going to get 100 each, multiplied by the intrinsic value of 15. So that brings us to 225,000 if you punch your calculator. That means that out of this liability here in year 2 of 413, we are going to pay off 225,000. That means we will need to reduce our liability by debiting it and we'll credit back. When you do that, that means your liability will reduce from 413,000 to 200, and it will reduce not to by 225,000. That means the balance in our liability will now be 188,333 as a result of the exercise. Now that 150 has exercised now, what is now the remaining value of this option at the end of year 3, which I call the unexercised? Don't forget, 100 options or SAR. We had 500 employees. 35 actually left in year 1. 40 left in year 2, 22 left in year 3, and now 150 has exercised. Okay, then we are going to measure this at the fair value of that option at the end of year 3, which is 18.2. And this is where I got the 18.2 from, the fair value. So when you punch that on your calculator, it brings you to 460,460. So that means the remaining employee that had not exercised is 253. Multiply by fair value by the number of options, it gives you this value. Now, this value is our liability now. So it goes to liability. So how much goes to P&L? Is the increment, okay? The increment goes to P&L. Don't forget, our liability is now 188,333 because some have exercised. Now, it has increased from here to 460,000. So, that increase will go to where? Will go to P&L. That's 270,127. What happened in year 4? Even though everything went in year 3, because that's the vesting date, but not all of them exercised their XAR in 2023. Some exercised in the next year. And how many exercised in the next year? 140 employees exercised their XAR at the end of 2004. So that being the case, so in 2004, at the end of that year, who have exercised? We're told in the question that 140 employees exercised. Each of them will get 100 SAI. And we are going to be paying them at the intrinsic value, which is 20. And this is where I got it from. Intrinsic value in 2024 is 20. If you punch your calculator gives you 280, which means that out of this liability of 460,460, yeah, we would have to pay 280,000. So our liability is reducing by 280,000. We debit liability, we credit bank. We debit liability, we credit bank. What would then be the balance in your liability? It was 460 before. We have settled 280, remaining 180, 460. 180, 460. Now, since 140 has exercised, don't forget, it was 253 that was remaining before. Now 140 has exercised. So there are still some that are unexercised, which is 253 minus 140. If you put your calculator, that's 113. Multiply that by 100, multiply that by the fair value at the year end, which is at the end of year 4, or at the end of 2004, I mean. If you go to the question, 2004, the fair value is 21.40. And that was where I got this 21.40 from. If you punch your calculator, the value of liability now is 241,820. Is now 241,820. Don't forget that when we paid those that has exercised, the liability came down to 180. But now that we are remeasuring, it is now 241,820. Of course, this is what the balance in our liability account will look like. However, the increments from 180 to 241 shall be recognized to P&L. Shall be recognized to P&L. Now, in 2005, I would expect that, where is it? Okay. And the remaining 113 employees exercised their rights. So it's, from our calculation, it was 113 that was actually remaining ordinarily. So the remaining that have exercised their rights. So let's go there. At the end of 2005, the remaining 113, which is the same thing as this 253 minus 140, okay, 113 was what was N exercised. Now they have told us that this 113 has exercised. So each of them gets 100, and we're going to pay them at the intrinsic value, which is 25 naira. And that gives us 282,500. But looking at it closely, what we were owing is 241,820, because that was the liability at the end of the previous year. But now we will have to pay 282,500. So by the time you debit your liability and credit bank with that amount, there will be a shortfall in your liability because you have paid more than your liability. That's an additional cost to you of 40,680. Just take it to staff cost to P&L by crediting your liability and debiting your P&L with that additional cost. And that is it for cash settled share-based payments. I can promise you, you will not find something more advanced than this in the exam. Never. It's not possible. Because these are taking care of the entire history of whatever you can find in a question of cash settled share-based payment. And that is it for cash settled share-based payment. If you have any question, this is when you ask. Okay then. No questions. Now, the last form of share-based payment is the one where there is a choice of settlement. Is the one where there is a choice of settlement. So, this is one where the counterparty, in this case, usually an employee, has a choice of receiving settlement either in cash or by the issue of shares. So, we are saying that the employee can decide whether this transaction should be equity settled or should be cash settled. You see, when you have this kind of transaction where the issuer or the entity or the buyer in this case is not sure on the choice of the counterparty, is not sure what the counterparty will do. He will only know at the vesting date. You see, this becomes quite complex. And that's what we call compound financial instrument. It's compound. Because for us, it could be either, it could go both ways, or it could go either of the ways. It could be either cash, where we have to pay cash, or it could be shares, where we have to issue shares. But for us, since we are not sure at the date we are accounting for it, we will need to consider the two of them, both of them. So whatever value we are promised to give, we will have to split it into, okay, the one that is cash settled, that we're going to recognize as liability, and the one that is equity settled, that we're going to recognize as equity. We have to find a way to split it. And splitting it is quite straightforward. Liability is what we will focus on because we will have to get that value first. And why are we getting the value of liability first? It's because equity is a residual interest in the asset of an entity. So when you get the value of the liability, just deduct it from the entire value of the arrangement. Whatever balance you get is equity. So that's the only thing here. For where there is a choice of settlement, it becomes a compound instrument. So you would have to separate, bifurcate, or identify the debt component from the equity component. I think without further ado, we should look at how this is done so that it brings more clarity to us. Let's use this question to do it. It says that Omega prepares financial statements 31st December each year. On 4th January 2003, Omega offers an executive the right to receive on 31st December 2004 either a cash payment equal to the value at 31st December 2004 of 5,000 shares or 6,000 shares. A condition of the issue is that these shares cannot be sold by the executive before 31st December 2006. Okay, so this is a typical example of what we're talking about. This company issued or offer its employees on these grant dates. It gave them that they have two options. It's either they collect cash equal to the value of 5,000 shares. You see that this one is cash settled, or it's going to give them 6,000 shares at that vesting date. This one is equity settled. So he has given them option. But you see, that choice will be made on 31st December 2004. That's when that choice will be made. But we are counting from 2003. So we don't know what choice they will make. For that reason, we need to bifurcate or separate that, which I will show you very soon. The question continues. He said that the right will only vest if executive remains employed by Omega and provides service in a 2-year period from 4th January 2003 to 31st December 2004. The executive is expected to remain in employment and so become unconditionally entitled to the rights. Okay, so we expect all of them to remain in employment. They now told us that share price movement for Omega over the 2 years are as follows: 1st January, 31st December, 31st December 2004. We're now told that the fair value of the share alternative is estimated at 9 naira. Okay, so that means the fair value of the shares itself, okay, that means the entire package itself is 9 naira each, right? So, but is this entire package now is what we are now giving them option to get. So, of course, nobody will ask you to calculate this 9 naira in the exam. They will always give us. They're not asked to calculate or account for this transaction. Okay, again, since we are giving them option, they have a choice of settlement, either in cash or in shares. So we will need to get the debt component first. And to get the debt component is straightforward. We just use the fair value at the end of the year. So it's just this 5,000 multiplied by how many employees do we have? This 5,000, they didn't tell us. So 5,000 shares multiplied by what was the share price at the end of 2003? That's 11 naira. Abi? That's 55,000. So 55,000 is the value of the debt component. That's the total value of the debt component. Now, how much would then be the equity component? The equity will just be the residual interest. Will just be the residual interest. So if you look at it, even before the end of the year, so I won't jump the gun. At the beginning of the year, when we want to recognize it in our books at that date, so the value of the debt will seem, yeah, since this is when they issued it, will just be this 10 naira multiplied by that 5,000. And the value of the debt component there, which is the value of the debt component, the value of the equity component there will be how many shares? It will be 6,000 shares. 6,000 shares multiplied by what's the share price? 9 naira. That's the fair value of the shares, 9 naira here.
At the grant date.
At the grant date, that gives us 54,000. That's the fair value of the entire package itself. That's the fair value of the entire package itself. So the value of the equity will be the residual there. So the fair value of the equity will be this 6,000 times 9,000, which is 54,000, which is the value of the entire package, minus the value of the debt component, which is 50. Then it is this 4,000 that becomes the value of the equity. Equity is a residual interest. Equity is a residual interest. So you see, this 4,000 at the grant date will represent that, okay, if this executive don't leave, as they have told us that they must stay there for 2 years, they must work for 2 years. If they don't leave and they choose, that means they will get 4,000 at maturity, at the vesting date. So this 4,000, we're going to recognize it over 2 years. over 2 years. So 2,000 naira per year, 2,000 naira each year. So, and they didn't tell us any of them will leave. So 2,000 naira each year. That's how we're going to recognize the equity component. So the only challenge you have in the exam is just for you to be able to get the value of the entire package, which they always give you, the fair value of the share alternative. In this case, is 6,000 shares multiplied by 9 naira, 54,000. Just remove the value of the debt component from it, which is 50,000. This 4,000 becomes the value of the equity. So this value of the equity, we just recognize it just like we usually recognize equity settled. Okay. Since they didn't tell us anybody will leave, so it's 4,000 divided by 2, equally over the years. Equally over the years. That's the equity settled. For the debts, this value is at the beginning of the year. However, don't forget, for cash settled, we remeasure it at the end of each year using the fair value at the end of that year. So at the end of 2003, the cash settled becomes 5,000 shares multiplied by 11,000. Let me show you. In 2003, the share price is now 11 naira. So the value of the debt is now 5,000 times 11. Again, this 5,000 is the value at the vesting date. So what you recognize in year one is just this 55,000 divided by 2. So you recognize that as liability. Then the other leg goes to staff cost in P&L. In 2004, the share price is now 12 naira. The share price is now 12 naira. So that means the value of the debt is now 60,000, 5,000 times 12 naira. Again, because this is the end of the year, so there is no need for, it's just times 2 over 2. So the liability value at the end of the second year is 60,000, which is the vesting period. However, what goes to P&L is just the increment, which is 60,000 minus 27,500. So 60 minus 27,500 is what goes to P&L, and that's 32,500. Just like we have always done. So nothing has changed here. The only work you need to do here is for you to separate the debt from the equity. That's your first work at the beginning of the year, to know what is debt, what value is the debt, what value is equity. For the equity settled, just spread it equally over. The examiner will not give you a scenario where somebody will leave. This one is already complex enough than for them to now add you. They will not. So they will just, for the equity settled, just spread it equally. So in year 1, 2,000, in year 2, 2,000, like that. But for the liability, cash settled, the value changes at the end of each year, right? Unlike equity that you measure using the fair value at the grant date, this one is using the fair value at the end of each year. So the 55,000 in year 1, we spread it over the 2 years. So in year 1, we only recognize 27.5, and the other leg goes to P&L. The vesting date, so the entire 60,000 becomes the liability amount, and the incremental goes to our staff costs. Therefore, at the end of year 2 now, if the employee chooses to collect cash, so we simply credit bank and debit liability. If the employee chooses to collect cash, we credit bank and debit, so we'll close his liability off through a debit and it's gone. But if the employee chooses to collect equity, again, that means whatever is in your liability, you debit it to cancel it out, which is of course 60,000. And you are now going to credit your equity with 60,000. And it ends there. And that goes to show that when you have this one where there is a choice of settlement, you will see that the way this works is that it's like we are debiting P&L, okay, and we are crediting debts and crediting equity. Okay, unlike equity that you debit P&L and credit equity for equity settled. For cash settled, we debit P&L, we credit liability. But for this one, when there is a choice of settlement, you consider both debt and equity. So your major task is this ability to separate it at the beginning of the year. Then at the end of each year, equity settled, just spread it equally. Cash settled, you spread it or determine the value based on the share price at the end of that year. And the one that relates to the current year, prorate, give it to it. At the vesting date, there's no need for proration. It will be the value. Then the increment goes to P&L. Okay. Then if the employee decides to go for liability, then cancel out the liability and credit bank. That is, if the employee chooses cash settled, but if the employee chooses equity settled, just credit equity and debit the liability. And that is it for share-based payments. That is it for share-based payments. So with this, I've discussed all the principles you need to know. Now, any questions before I go to the final subtopic?
This choice, there doesn't appear to be choice here. Guys, you must, the way it stands now, since we're, from what you explained, that the staff, we consider, is it the staff or the employer or the liability we recognize first, then the equity, the residual interest. That means the liability will always come first. So I'm just wondering, where is the choice here? It doesn't seem to be a choice between the cash base or the equity base. There doesn't seem to be a choice. That is my question. Yeah.
Yeah, so
You
the
just, you
choice
are
will
just
only
sharing
happen.
it.
Yes, so the liability will always come first. That's how liability is determined. You need to get the value of the liability. The value of the entire package itself is 50,000. Out of this 50,000, we need to separate it into liability and equity. So liability, would calculate liability first. Whatever is remaining is what debt takes. So for whatever is remaining is what equity will take. For equity, just spread it over the period, just like we deal with equity settled. For the liability, you remeasure it at the end of each year. Where the choice comes in, okay, where the choice comes in is at the vesting date. So they didn't tell us in this question the choice the guy eventually made. So that's why I've told you that if the guy chooses that, okay, he wants to be cash settled, then you just liquidate the liability. You debit the liability, credit bank. It closes off everything, right?
Okay.
Or if the
Okay.
guy chooses equity, credit equity, debit that liability to close it off.
Okay.
Yeah. Again, ICANN has never asked this. So all of this extra one that I'm teaching you, they have not really tested it. They have not really gotten to this length. So usually you will see them stopping at the ones I've done earlier. But I mean, you never can tell. Practice it in case they wake up and they want you to be sure that you have a knowledge of this. You are ready. Now, if there are no further questions, then we would move to the final part, which is deferred tax implication. I know that you have all done deferred tax. I know that you have been taught income tax. So learning this will not be difficult for you. Deferred tax hasn't changed. It's still differences, it's still tax arising from temporary difference. Tax arising from temporary difference. And that temporary difference is the difference between tax base and carrying amount, if any. So For share-based payments, especially for equity settled, for cash settled, that difference doesn't occur because it's cash. So, and for cash settled, we will measure it at fair value at the end of each year, which is what the taxman will reckon with. But for equity settled, you are measuring it at the fair value at the grant date, historical. Taxman will not reckon with that. So the tax
Can you
base,
repeat that your last comment, please? Just that last comment, what you were saying.
the equity settled is usually measured at the fair value of the option at the grant date. The taxman will not reckon with that. So what you are recording in your books, taxman does not like it. He does not like it today. Even though when invest in the future, he will be happy. But for now, he will not reckon with it. So there is a temporary difference between what you are putting in your books and what the taxman will reckon with. And don't forget, when Mr. Kazim was teaching you tax base, he said that tax base of an asset is the amount that will be deductible for tax purposes in the future, which is applicable here. So in the exam, or even practically, what you have recognized today, the taxman will look at it and say, no, this is not what I want. What the taxman would want is how much the employee will actually pay for these shares. How much the employee will actually pay. That is what the taxman will allow as your expense. Or how much. So, and this would always be the, what do they call it? The intrinsic value, or the whatever the examiner tells you as the value the taxman will reckon with. But from all ramification, it's always the intrinsic value that they would want to go with. So if that is the value of the shares, if that is what they feel you have incurred as a company, then that is what will become deductible in the future. So that means the tax base, when you want to get your deferred tax, the tax base is just the intrinsic value as at that date. While the carrying amount is, Mr. Kazim will tell you, which is either the carrying amount of an asset or the carrying amount of a liability. That's what income tax deals with. Here, the carrying amount is going to be zero because IAS 12 has nothing to do with the carrying amount of an equity. And don't forget, the other leg of equity settled goes to equity. So for us, the carrying amount is always zero. Is always zero. So for share-based payment, especially equity settled, while the tax base will be the intrinsic value, which is what the taxman would allow you to deduct as expense in the future, which is what tax base is anyways. The tax base is the intrinsic value. The carrying amount is zero. And when the tax base is higher than the intrinsic value, where you would have a situation where you are going to have a deduction in the future, that means we'll be having a temporary difference that is deductible in the future. That means you are going to be having a deductible temporary difference, because it's a temporary difference whereby in the future you will be able to deduct whatever it is that you would incur as expense, as an allowable expense. It's not going to be allowed now, but it's going to be allowed at the vesting date. So that means it's a deductible temporary difference for you. And deductible temporary difference will always result in a deferred tax asset. So the lock you have here is this. For equity settled, there's a pattern. It does not change. So you can zero your mind that whatever the examiner gives you as the tax base, which from all questions we have seen is always the intrinsic value, is always the intrinsic value, is always the intrinsic value. That's what the taxman has seen as what is the, that's what they see as what you have incurred. That's what they will see as staff costs. The fair value of the share option at grant date that you are recognizing, the taxman will not reckon with that. So what they will allow as deduction is the intrinsic value. And they will tell you in the exam. They will tell you. If the examiner tells you otherwise, that means whatever the examiner tells you that this is what the taxman will allow, that's what you should use as your tax base. However, the carrying amount is always zero. Always, because there's nothing like carrying amount of equity. Zero. However, since you would have a deduction in the future, because it's going to result in a deduction in the future, then we have found ourselves in a situation of a deductible temporary difference. And when you have a deductible temporary difference, then that is going to be a deferred tax asset. Deferred tax asset. Okay, that is all for deferred tax. So 2 diets ago for 15 marks, they asked deferred tax implication of share-based payment. A lot of people don't pay attention to it. So pay attention to it. They can ask it. You have to know it. So let's look at this question. It's always very straightforward. So a company operates in a country where it receives a tax deduction equal to the intrinsic value of the share option at the exercise date. Okay, so this is what I was telling you. Look at the way they started this question. They already told us that the company operates in a country where it receives tax deduction equal to the intrinsic value. So that means the tax base is the intrinsic value. So at the exercise date, of course, that's when the taxman will allow it. So we're not told that the company grants share option to its employees on 4 January 2005 with a fair value of 4.8 million at the grant date. So this is the fair value of the option. The intrinsic value at the end of the year is 3.8 million. So they have given us the intrinsic value. And at the exercise date is 4.8 million. The tax rate applicable to the company is 30%. And the share options vest at 31st December 2006. That's 2 years vesting period. We're now asked that what deferred tax assets should be recorded in the financial statement for the year ended 31st December 2005 and 2006. You see that the examiner even asked what deferred tax asset. They know that we cannot never have a deferred tax liability in equity settled share-based payment. We would never. You can only have a deferred tax asset. And for cash settled, there is no deferred tax, there is no temporary difference. So deferred tax doesn't really come in here. So you see, the deferred tax will be the tax base, which is the intrinsic value at the end of the first year, which is 3.8 million. And that tax base, because the carrying amount will be zero, that means this 3.8 million automatically becomes the deductible temporary difference. Automatically becomes the deductible temporary difference. And if you remember what Mr. Kazim taught you, as soon as you apply your tax rates to this deductible temporary difference, you immediately get your deferred tax. And in this case, a deferred tax asset. So whatever you get, since this relates to 2 years, don't forget, this value is in the next year. is happening in the next year or at the vesting date, which is 2006. So that's why we need to get the portion relating to year one alone, just like we have been doing. So 1/2. That gives 570,000. You see, with this 570,000, one leg will go to income tax. But in this case, it's a credit to income tax, deferred tax income. The other leg will go to deferred tax assets under non-current assets. At the end of 2002, they have told us that the intrinsic value at the exercise date is 4.2 million. Since the carrying amount is always zero for deferred tax purposes, so that means this 4.2 million becomes the deductible temporary difference. If you multiply that by 30%, it gives us 1,260,000 as our deferred tax asset. There's no need for proration in this case because this is the vesting date. This is the year two. This is the value at the end of year two, the cumulation. However, what goes to P&L, just like you have always learned, is the incremental. So the difference between this 1,260 and this 570 will go to P&L. But what the question is asking is the deferred tax that will be recorded. So this is the deferred tax as at the end of 2006. But what goes to P&L is the increase. So it's like you are crediting the increase to P&L under your income tax. So at the vesting date, this deferred tax of 1,360 will automatically becomes a current tax. Automatically becomes, because that's when it will vest. So as soon as it vests, there's no deferred tax anymore. Just write it off to current tax assets. Then it leaves your books so that you won't be recognizing deferred tax anymore. And don't forget that deferred tax can only be recognized if there is sufficient future taxable profit available against which you can net off the deferred tax against. So that's one of the conditions in IAS 12. Okay, so that's the whole idea behind deferred tax. I won't want to close this class without not touching on the question that was asked in May 2023. That's like 2 days ago. So the same thing, that question says that you are required to evaluate the deferred tax implication of the share option for the year ended May 31st, 2020 and 2021 for 10 marks. So they call the company Omoge Nigerian PLC, has the following share option scheme for its directors as at May 31st, 2021. So these are the directors, Adamu and Shuku. The grant dates, Adamu got his own from 2019. Shuku got his own from 2020. And what are they giving them? They gave Adamu 400 options. They gave Shuku 1.2 million options. So the fair value of the option at the grant date, 3 naira for Adamu, 2.5 naira for Shuku. Let me give that person. Let me give him blocking. Okay. The exercise price is 4 naira for Adamu, and is for Shuku is 5 naira. The vesting date 2021. That will be 2 years vesting period for Adamu. For Shuku Eze, that's with 2023. That's how many years? 1, 2, 3. That's 3 years for Shuku vesting period. Okay, so they're giving us all the relevant details. We're now told that the price of the company's shares at the end of 2021 is 8 naira, and at May 2020 is 8.5 naira per share. The directors must be working. Directors must be working for Omoge on the vesting date in order for the options to vest. No directors have left the company since the issue of the share option, and none are expected to leave before June 2023. The option can be exercised on the first day of the month in which they vest. In accordance with IFRS 2, an expense of 600,000 has been charged to P&L in the year ended May 31st, 2020, in respect of the share option scheme. So, and the cumulative expense for the 2 years is 2.2 million. I mean, they don't even want you to be calculating expense, whatever. They are already giving you what goes to P&L already. We're now told that tax allowance, this is where we are going, arise when the option are exercised, okay? And tax allowance is based on the option intrinsic value. That means our tax base is the intrinsic value, okay? Assume tax rate is 30%, evaluate the deferred tax implication. So this is why me, and which is what you should do as a practice, you always read the requirement of the question first. I'm sure your teachers, your lecturers will have told you that. So since I know that what they want me to do is defer tax, this is what I've been looking for since all of these stories I've been telling me. I've been looking for this one. That was the tax base. What was the tax base? So they have already told me that it's intrinsic value. Fine. So I know that all of these stories that have been telling me, I don't really need most of them. So now, let's calculate the deferred tax. At the end of the first year, which is May 2020, it was only Adamu that was there. Shuku was not there yet. So the deferred tax now, only Adamu was there. I just need to get the tax base because I know carrying amount is 0, right? So how do I get the tax base? They didn't give me tax base directly like they did in the previous question. So my intrinsic value in the last class I taught you is the share price minus the exercise price. So the share price of this company at the end of the first year is 8.5 naira, which they gave me here. 8.5 naira at the end of 2020. So I multiply that by the number of options to Adamu, which is 400 options. These 400 options here. Yeah. So that gives me 3.4 million. The exercise price is 4 naira, which is this 4 naira. I multiply that by 400,000. Together I have 1.6 million. So if I remove this exercise price from the share price, I get the intrinsic value, which is my tax base. My carrying amount is 0. That means my deductible temporary difference is 1.8 million. Then my deferred tax is simply 30% of 1.8 million. Which is 540,000. Now this 540,000, since the vesting period is 2 years, from 2019 to 2021, 2 years, I divide it by 2. I spread it over 2 years. I can't recognize the entire 540 in year 1 alone. The vesting period is 2 years, right? So I recognize 270 as my deferred tax asset. That's in year 1. So I'm done with the first part of this question. Talking about 2020. Now in 2021, so this guy has also come in then in 2021, this second guy, because he came in 2020. So at the end of 2021 now, he's already there too. So I need to break it down. Adamu and Shuku. So I'll do it separately. I get the intrinsic value for Adamu and that for Shuku separately because they have different share options. So for Adamu, the share price is 8 naira at 2021. 8 naira times 400,000. This is the 8 naira times 400,000. Then for Shuku is 8 naira times 1.2 million, which is what I did here. 8 naira times 400, 3.2 million. 8 naira times 1.2 million, 1.6 million. Then the exercise price for Adamu is 4 naira times 400, 1.6 million. For Shuku, the exercise price is 5 naira. So 5 naira times 1.2 million, that is 6 million. So I have my share price. I have my exercise price, share price, exercise price. I get my intrinsic value, 1.6 million, 3.6 million, which is my tax base. If I apply 30% on this tax base, 30% of 1.6 million gives me 480,000. 30% of 3.6 million give me 1,080,000. But since this is a year one for Shuku, and the vesting period is 3 years, so I spread it over 3 years. The one that relates to 2021 is 360. But as far as Adamu is concerned, this is the vesting date, so I don't need to prorate anything. That means my total deferred tax assets is 480 for Adamu and 360 for Shuku. That means my total deferred tax assets is for 840,000. What goes to P&L is incremental. The closing deferred tax is 840. The opening was 270. This 270 here. That means what goes to P&L is 570. But this is my deferred tax assets at the end of that year. And that is it for deferred tax implication. So these are the disclosure requirements for share-based payments. So every standard has a disclosure requirement. So there are 3 main headings. Okay. It requires extensive disclosures, but there are 3 main headings for share-based payments. Number 1 is that you need to tell us the nature and the extent of the share-based payment transaction that exists. You need to tell us, is it equity settled? Is it cash settled? You need to tell us. If you don't tell the user, they won't know. So you need to do an extensive explanation of the nature of the share-based payment. You need to tell us how you have determined the fair value of the goods or services received, or the fair value of the equity instrument granted. You need to tell us the truth. And you need to tell us whatever amount you have recognized as expense in each of the year, what is the impact on the profit or loss in the period? So disclosure is just about explaining your figures, explaining the concepts behind what you are recognizing. So in the exam, I mean, you can find a way to understand that what they want you to present is just explaining your figures. You should tell us how you have gotten the fair value of the goods or services received. You should tell us how you have gotten the fair value of the equity instrument granted. You should tell us the impact of the amount you have recognized in P&L to profit. And you should also explain, are you using an equity settled or cash settled, or the one where there is a choice of settlement? And that is the end of this class on share-based payments. I have a lot of practice questions here. It is nothing new that I've not mentioned in this class. There's nothing new here. And there was a question that was asked in 2020. This one is a simpler question compared to what we have solved here in class. So go and solve this. I have many other questions on share-based payments that I can continue to send to you. But I mean, rather than giving you information overload, I would really appreciate that you'd read through this, you watch this video that will be posted on YouTube over and over again. You understand this topic, understand it very well. So if ICANN is going to ask it, you will not be shocked. You will not be caught unawares. You're ready. And don't forget that we are always here for you if you have any question or you have any areas that you don't understand. But for today, I'm done with share-based payments and I'm done for the class today. Next week, we're going to be moving to a new topic. So this is when you can ask questions if you have any. If you don't, you would have to go and sleep for today. Any questions? So I'll see you next week. Thank you very much. Bye.
Thank you,
Thank
sir.
you.